Hi, my name's Steve Walker, and today I'm going to be talking about bridging loans, but I'm going to go into a lot of detail about the pluses, the minuses, the pitfalls, what to look out for, what to avoid, and how you can get into trouble with bridging loans, but also talk about the uses of bridging loans. Now, within this video, there's a lot of information, but we have got a YouTube channel, Promise Money's YouTube channel, where there's more videos which go into more detail on specific areas of bridging, so please do check that out. Or go to our website and our bridging overview page, which could be where you're watching this now. You'll find links in there which will help get you to more information, because there's so much to say I can't cover everything. So this is a very high level whiz through. So let's talk about how you might be using bridging loans to start with. The common perception is that they are used in a chain break scenario. That's where the classic is you own a house, you've seen another one you love, you need to buy it, but you can't buy it until you've sold yours. You haven't got enough cash or deposit to go and buy it. So you take a bridging loan, and the bridging loan can be secured on the one that you're buying. It can be secured on the property that you're selling if there's equity in it, as long as between the two you can raise enough equity to go and buy that property. So that's a classic. So, and when your other property, your existing property, is sold, the bridging loan is paid off. So that's a classic scenario. Another scenario that we're seeing a lot of at the moment is bridging refurbishment loans. So this is typically for property investors. They see a property that they want to buy. They've got to do some refurbishment to it. They can't get a mortgage on it to rent it out until that refurbishment is done. So typically, again, they might use a bridging loan for that. And there's some good products specifically for that, up to 85% of the value of the property, provided you're using part of that loan for refurbishment. So that is a really good product as well. And again, there's a video specifically dealing with that on our YouTube channel on the website. Another scenario is bridging to get planning consent. Now, we're seeing a lot of this at the moment. So imagine that you've seen a property, you think that could be great. If I could convert it or if I could extend it, there's a load of profit in it. However, you need planning consent to get those things done. So you can't go straight for a development loan or anything like that, but you want to secure it. So you take out a bridging loan to buy it, and then you'll go out and get planning, and then that's going to open up a whole raft of opportunities for you. Now, in that scenario, you could take out one bridging loan to buy it, get the job done in terms of the planning and what you get all of your plans drawn up, and then take out another different type of product. But be aware that depending on what you're looking to do, you might be able to find a lender who will say, we will lend you so much for the bridging. We know what you're looking to do. We believe that you're likely to get planning. We won't release that money to you until you've got that planning, but we will consider a further advance or restructure the loan in such a way that it can save you money, because they're not two totally separate transactions with two valuations, two sets of legals, etc. So that's something to bear in mind on that. Talk to us about that one. And then the other classic, and this is a bit of a misconception, I suppose, to a certain degree. You're bridging because you need the money fast, and bridging loans can be done very, very quickly. Secured bridging loans. There are lenders out there that do all of the legals in-house. They'll even try and avoid a valuation, and they can turn things around very, very quickly. But generally speaking, what slows down bridging finance is you need to have a valuation and solicitors. And I'll talk about solicitors later because they wind me up, so I'm not going to talk about them now. So yes, you can get loans for bridging fast, to refurbish another property, to provide business cash flow. You might be buying at auction. There might be a pressing or urgent debt that you need to repay. Classic tax, HMRC, got to pay tax. Where am I going to get the money from? Take a bridging loan out. That'll tide me over until I sell that asset or sell that property and get that done. But solicitors and getting it done quickly, it's not always as easy as it seems. I'll talk about that in a moment. And then we've got bridging to develop. So you've got planning. You've seen a property. You want to go and buy this property, and you know exactly what you're going to do with it. And that is a bridging pseudo development loan. There are bridging loans that let you do that, and if you're doing a light refurbishment, bridging could be fine. If you've got planning to do certain work and that's already in place, there are loans, especially if you're converting from commercial to residential. There are specific loans which are brilliant for that, and they allow you to convert to residential at a very high loan to value, so you haven't got to put as much cash in for yourself, and effectively you can raise most of the money that you need to buy the property and all of the money that you need to develop it. So really good development products. As you go further, if you're into ground up and you're building something which is essentially it's a field or it's a total knockdown, then that moves away from being bridging more into straightforward development finance, and that's a different thing, and there's a video on that as well, so look out for that. Okay, so let's just talk about the application process. So when you're applying for bridging loans, you're going to have to provide a fair bit of information, but the key things that lenders are going to be looking for is what's the security, what's the loan amount and the purpose of the loan, and what is your exit. And if you are using the loan for development or building, they're going to also ask about your experience. And there's a whole range of lenders who will go from those who will service those who have no experience to those that tend to service those who've got loads of experience. The key thing is to understand there's a massive market out there for bridging, so there's lots of choice. So what we need to do is just understand what it is you're looking to do, what your exit is, and I guess put you together with the most appropriate lender for those circumstances. I just want to talk a bit now about how long it takes to get a bridging loan, because there are a lot of factors that come into that. I guess I mentioned valuation, but there's also the complexity of your situation. And if you're looking for a bridging loan which is to develop and you haven't got planning, well, that's going to take time. If you're looking for a straightforward bridging loan because you want to buy a property, then you're more likely to the delays are more likely to be around the valuation and the solicitors. And I suppose I'll talk about solicitors now, because valuations, you can overcome valuations to a certain degree. If it's low loan to value bridging, you can actually get a loan where the lender will use what's called an AMV. It's an automated valuation or a desktop valuation, where somebody who is an expert will look at properties sold in that area and come up with an estimated value for the property and the amount of confidence they've got that right. And if that fits, then the lender won't need a valuation. If you do need a valuation, best chances are, if it's a residential valuation, that's going to be at a week minimum to the process. If it's commercial, it could easily add 2 weeks. A week for them to get there and a week for them to type it up, and then even a little bit more time to argue about what they've typed up, because you might disagree with what they've said. So valuations, you've got to factor that into the equation. So if you're buying at auction, be aware of it. But the real big one is solicitors, and I will spend a moment talking about solicitors because generally, in my experience, most are rubbish at it. Not only do they not understand bridging loans, they also work at a totally different pace. So your residential solicitor, the guy down the road who might do a house purchase for you, my experience, and I'm sorry if the solicitor's watching this, but my experience is they'll think nothing about going away on holiday for a week and leaving everything until they come back. In our business, if we're on holiday, you hand everything over and say, make sure these things happen while I'm away and keep it moving. Solicitors don't seem to do that. And they just don't work at the pace that you require for bridging. So you choose your solicitor carefully. Find a solicitor who's a commercial solicitor or a bridging specialist solicitor, and they do things really, really quickly. Now, there are some lenders who do something called dual representation, and that means that they have two firms of solicitors who work together every day for them. One represents them and one represents you. Now, the advantage of that, as long as they're decent dual rep solicitors, is that because they work together every day, they know how each other thinks, and all they're interested in is getting the deal done as quickly as they possibly can. In some cases, they're even in the same building, so they can walk and talk to each other and say, what do you think? Sort it out. What you get with your provincial solicitor is the lender solicitor asks for some information, and his first response is, well, you don't need that, or why do you need that? And we get into this contest about who's the cleverest. Dual rep avoids that. Specialist solicitors avoid that because they just want to get the job done. They're not showing off. They're not trying to impress you or justify their fee. Anyway, that's my rant about solicitors over. Is bridging a good idea? It depends. And I think it's really, really important at this point to think about what it is you're trying to do and have advice. If you are buying a property and you've seen one over here and you can't sell that one over there, you need to talk to an advisor about it. But that advisor needs to be somebody, and these are quite rare. It needs to be somebody who's regulated to offer you mortgages, really understands bridging, and also understands all the other options like second charge loans, or maybe even development finance, but can look at the whole picture and then say, well, these are the alternatives to bridging. Because let's face it, bridging compared to a mortgage rate is quite expensive. But if you need to have it done really, really quickly, maybe bridging is the way to go. Or you might have another property somewhere and say, well, why don't we take a second charge on that? So is it a good idea? Yes, it is, because it enables you to achieve your goals. Bridging is a facilitator to make things happen. And if that thing that is going to happen for you is your dream home and it costs you a little bit more on the rate for bridging, that's fine. If it's a business deal and you need the money to make that business deal and you're going to make a load of profit on that business deal, then it's a great idea. Bridging is brilliant. But you need to talk to somebody who's going to look at all of the options, because they might say, well, have you thought about this or have you thought about that? And that could give you a solution, which isn't bridging. The thing to know about bridging, though, is it can be faster and should be a lot faster than a mortgage, but the interest rates are likely to be a little bit higher. And the key thing about bridging is it tends to not be indefinite. So there is a limit to how long you can take that facility for. And the other good thing about bridging is what it does do that mortgages don't let you do is it lets you roll up the interest into the loan. So if you're buying a house over here and you've got a mortgage over here and you can't afford to buy that house, a bridging loan will allow you to roll up all of the interest into the loan, so you haven't got any repayments. So it's great for cash flow. Okay, so yeah, but always use a broker who's fully regulated and can look at the whole market for you. And I'll go into a bit more detail about the rolled up interest now and things like that. Eligibility for bridging, well, creditworthiness is important, but bridging lenders are more flexible and relaxed about your creditworthiness than, let's say, your mortgage lender is going to be. And the reason for that is if they're rolling up the repayments into the loan, they're not worried about you having to make the repayments. So they don't have to assess your ability to make repayments or your willingness. And creditworthiness is often about either willingness or ability, won't pay or can't pay. So it's less of an issue. Your income, do they need proof of income? Well, if you want to service the loan repayments on a bridging loan, which you can do, then they will assess your affordability. But if you don't, you want to roll it up into the loan, then it's less of an issue. What is important, I think, is the property value, because the lender is really, this is an equity loan. They're looking, what's the property value? How much am I prepared to lend in total? And if it all goes horribly wrong, can I get out without losing money? So they will look at the property value, they will look at the property type, and they'll make an assessment of how much they can lend you based on that. Okay. The purpose of the loan is less important, really, as long as it's a legal and ethical thing that you're looking to do. But the other big part of it is your exit strategy. So if a lender says, and let's make the maths easy, you've got a £100,000 property and I'll lend you £75,000 secured against that property, whether that's the gross loan with interest taken out, it's kind of irrelevant. They need to know that in 12 months time or 18 months time, when you say you're going to exit that loan, that you're going to be able to do so. So what is a good exit? My property's on the market, I'm going to sell it. Okay, I've had it valued and it's likely that you will be able to sell it during that period of time, so that the lender's happy. What is another exit? Not necessarily quite so good. I bought this property, I'm going to do it up, and I'm then going to put tenants in it and I'm going to refinance it. Well, that's also a decent exit, but this is where your credit history comes into play. Because if your credit history suggests that when you get to that point, nobody's going to lend to you because you've got a poor credit history, then your exit's not going to work. So in a refinance scenario, the lenders are going to say, that's fine, we'll lend to you, but what we'd like to see at this stage, and that's where we as a broker can help, we'd like to see a decision in principle from a lender saying that they're going to lend to you when the time comes, so that they know that there is a strong likelihood that you can get that refinance. But like I say, if you've got a poor credit history, that's going to be affected by this. A poor exit is, my boss has told me he's going to pay me a great bonus at the end of the year. As far as the lender's concerned, that's nonsense. It doesn't exist, and therefore they'll ignore it and they won't lend to you. So you've got to have a decent exit. Right, let's talk about LTVs a little bit and deposits. If you're buying a property, you're going to be thinking about the deposit, but very often bridging is also being used where there's multiple properties and or it's for refurbishments. So it's not so much a deposit, it's more about, well, what is the equity? And that's what you've got to get your head into. What is the LTV that I am borrowing? LTV is clearly the loan to value, and easily expressed, if you've got a £100,000 property and a £70,000 mortgage, then the £70,000 mortgage is 70% of the value. The LTV is a 70% loan. So on bridging lenders, on straightforward residential property, generally speaking, you're going to be able to borrow up to 75% of the value of the property. Now, that 75% is the gross loan that the lender's going to give you. Out of that, they'll take their fees, often around about 2%. Any other costs might come out of that as well. There might be some solicitor's costs or bits and bobs like that. Plus, if you are electing to roll up or retain interest so that you haven't got to make repayments, that will be taken out of the 70% as well, or the 75%. So in the scenario of a £100,000 property, 75% gross loan, less your fees, less your rolled up interest, you could easily be netting 60 to 65%, depending on how long you take the loan over. And that's another factor. The longer you take the loan over, the more interest there is, therefore the larger that amount of retained interest that is deducted from the loan. So residential, however, 75% is the norm on a first charge. Some lenders will be around 65 to 70, but there are lenders currently doing 75%. You can take a bridging loan out on a second charge. So if you've already got a mortgage, don't be persuaded, unless it's the absolutely only option, to pay off that mortgage, which could be at a really good rate, with a bridging loan. Because what you're doing, you're taking that entire mortgage at that cracking rate and replacing it with a bridging loan at a higher rate. It might be better for you to actually keep that loan and apply for a second charge bridging loan, which means the loan sits behind your existing mortgage with a different lender, and they lend you the small amount that you need on top. So you're still keeping the benefit of that lower rate, which is good news. You might be paying slightly more on the bridging rate because second charges are a little bit dearer, but the blended rate that you'll be paying could be more cost effective for you. On commercial properties, the loan to value is not going to be as good. 75% unusual. I would say not really. If it's semi-commercial with a high residential element, you're going to get closer towards that. If it's fully commercial, it could easily be 60, 65, 70, a real push. Depends on the market at any one time. If the market's really strong, then lenders compete and they'll offer a little bit more. But if you bank on 65 to 70% on commercial stuff, on a first charge, that's where you're likely to be. Land with planning consent. Now, if you've got land, and I'll talk about this again in a moment, if you've got land that's got planning consent on it, then the value of the land has an inherent additional value in that you can develop it and it'll be worth more in the future. So you can get better LTVs on that. And if you are looking to do a development bridge, they could potentially lend you certainly 65-70% of the value of that land at day one, and some might even go, in a good market, go to 75%. Plus, they'll then lend you further money on a drawdown to do the rest of the work. There's a video on development, watch it. It's a good one. If it's a bare piece of land and there's no planning on it, it's a field, then you're probably going to be nearer to 50% loan to value. A lot of people contact us with this. It's a bit of a dream, really. There's a piece of land I've seen. I'd like to buy it. It's in the middle of the forest, and I'm going to build a house there. But there's no planning. Well, the chances of you building a house there are slim. A lender's only going to lend you based on what it's worth now, and it's going to be a low loan to value. It's going to be circa 50% at best, really. So land without planning, not so hot. Right, let's talk about regulated and unregulated. if you're watching this as somebody who owns their own home and you're looking to secure a bridging loan either on the home that you own or a home that you're planning to buy, then that's going to be regulated. Now, it's important that you understand the difference between regulated and non-regulated. Regulated means that the FCA regulates the lenders and the brokers that offer it and the product, okay? And that means that the product and the process comes with some fairly rigid rules around it. They are there intended to protect you, the borrower, okay? So in terms of lenders and brokers, there aren't as many regulated lenders. There aren't as many regulated brokers. So you need to find one of those. Don't go to a non-regulated broker or lender because it's no good. They can't do it for you. And if they can, if they do, they're breaking the law. But what that also means is because this regulated lender or this regulated broker as a business is regulated, whether they're offering you a regulated loan or a non-regulated loan, they have got that regulated ethos. They have got a business which has to demonstrate to the FCA that they treat their customers fairly. So you are in safer territory, safer ground. So with a regulated loan, you've got a complaints procedure. You can go to the ombudsman. You've got cooling off periods, and there's a process that the lenders have to follow to make sure that this bridging loan is going to be a good outcome for you. And they're certainly going to make sure you've got a decent exit. If there's a downside to regulated mortgages and loans, because the FCA puts much more onus on the lender and on the broker, they tend to be more cautious. They therefore have more robust processes, which can slow things down. More robust affordability calculations. And the key thing is that the FCA in their wisdom have said that a regulated loan can only be for a maximum of 12 months. Now, non-regulated loans, you can get them up to 3 years, which means if it's a regulated loan, you've got 12 months to do what you want to do and exit. Which in most cases, if you're selling a property because you're moving, that's fairly reasonable. But what the FCA haven't really thought about is that person who says, well, I want a bridging loan because I'm going to knock my house down, I'm going to rebuild it, and then I'm going to remortgage it, or I'm going to sell it, or I'm going to split it into different flats. Try getting that done in 12 months. Not easy, nigh on impossible. So the FCA really haven't made life easy for you there. But in other regards, apart from it's a bit of a faff and it's got to be fully advised, it's a good place to be. Perhaps the best place to be is, from your point of view, in terms of getting things done quickly, is a non-regulated loan being done by a regulated lender and sourced for you and packaged by a regulated broker. Because whilst the loan itself isn't regulated, as I said earlier, the people who are providing it to you are. So that gives you much more comfort. And I will talk a little bit more about some of the downsides of non-regulated in a moment. Okay, now I'd just like to talk about different ways that interest is added to your loan or paid. So firstly, you've got retained interest or rolled up interest. Now they are subtly different, but what that actually means is if you borrow £100,000, that's the gross loan, and the lender takes off their fees, they can also take all of the interest that would be paid over the term of the loan and deduct that from the amount that you get in hand. So your £100,000 loan might only get you £80,000 in hand because you've got £20,000 worth of interest and fees in there. The advantage of that is it's great for your cash flow because you can get on doing what you want to do without having to worry about making any payments. Now, the difference between rolled up and retained interest is it's the compounding element of it. One of them will say, right, we're just going to take a big chunk of interest and we're going to knock that off. So if it's 1% per month and it's a 12-month loan, we're going to take a chunk of 12% and take that out of the amount you get in your hand, and that's retained. If it's rolled up interest, they might say, well, we're going to calculate the interest that you're after month one and add it on, and then calculate the interest after month two. So you've got that compounding element of the interest. So it can work out slightly cheaper, but there's not an awful lot in it, so I shouldn't worry about it. The key difference is, do you want to have the interest added to the loan, or do you want to service the loan yourself? And when I say service that loan, I mean, do you want to make monthly payments? And you will have options with certain lenders, not all, to make part and part. So you can service part of it, and you can pay part of it. Now, the advantage of servicing the loan is that if you've got that £100,000 loan, yes, the lender might knock off a couple of percent for their fees, but you get the rest of it, because that interest isn't being added or being subtracted from the amount that you get in your hand. And the reason that's important is that if equity is tight, then the amount you get in hand is really important to you, because if you're trying to raise the maximum amount that you possibly can by servicing the loan yourself, that's going to get you in the scenario of 12%, an extra 12% in your hand. So you get a bigger loan. So that's the difference between the two. The other factor is, if you are servicing the loan, then you've got to prove you've got the ability to service the loan. So with most bridging lenders, where the interest is being added, they're not going to get into a lot of detail about affordability because it's being deducted from the loan. If you're servicing it, then full affordability checks need to be done, especially if it's regulated. They'll be all over it, and that just adds an extra element into the process, which can slow things down. So that's just something else to be aware of. Loan amounts on bridging, I guess strictly speaking, from 10,000, 5 to 10,000 with some lenders, up to 10 million and potentially even more. So the range is massive. So I don't think you need to worry about that. In terms of bridging rates that you're likely to pay, well, that depends on where the base rates are at any one time. But in the last 12 months, I've seen rates from 0.45% per month, and that's on a low loan to value, straightforward residential bridging loan, up to 1.5%. And there will be some lenders that will charge more than that. Well, they do. But that's probably the range where you're going to be. Now, at the time we're doing this video, base rate's 4%. So you're not seeing 0.45%. You're probably seeing more like 0.65% per month. But it varies. The key thing is you've got to engage with a broker who's got access to all of these products at the time, and he will take into factor what's the property type, what's the loan to value, what are your circumstances, what's your credit history like, how much do you want to borrow, take all that into consideration and be able to tell you what rates are available. But it's quite a range. Right, okay, something else to consider, repaying a bridge early. You know, I mentioned if you borrow £100,000 and there's a chunk of interest which is deducted from the loan, which means you get less in hand, you need to be aware, because a lot of people look at the paperwork and say, right, so I'm taking a £100,000 bridging loan, and it's going to cost me all of that in interest. That's too expensive. But bear in mind, you're building that interest in there for, I guess, contingency. If you might take out an 18-month loan, but in your mind you think, I can get this done in 9 or 10. So there's another 8 or 9 months or 10 months or whatever of interest which you won't use. Now that's going to show in the credit agreement or in the loan agreement as if it's money that you have spent, it's interest that you've been charged, but you haven't been, because you're going to get charged for the interest that you use. So if you've got an 18-month loan, and after halfway through month 11 you say, job done, we're now ready to either sell our property or exit or refinance, you refinance, and the unused portion of interest will be deducted from the balance, i.e. you get it back. So bear that in mind, because when you look at the agreements, they look horrendous. Bear in mind you're going to get a chunk of that back if you settle early. And always with bridging, assume that it's going to take longer than you originally thought. I guess there's a caveat to that. A lot of bridging lenders, not all, but a lot of bridging lenders do have a minimum term of 3 months. So if you settle within 3 months, they might still charge you 3 months interest, but it's very rare that anybody takes out a bridging loan and settles it within 3 months. Where there's greater concern in my mind is in the small print with regards to penalties if you go beyond the stated term. So you need to think about if you're tempted to try and get it done really, really quickly, and the documents it looks really horrendous for the interest amount that's on there. You think, oh no, let's just go for a 12-month term. If you go over that 12 months, the lender can potentially charge you penalties because you've breached the agreement. You are in default of the agreement. If it's a loan where you are servicing the debt and you miss a month, you are in breach. You have defaulted the agreement, and different lenders have different rules on what they will do and how they will treat you in those circumstances. And again, this comes back to regulated versus non-regulated lenders. Regulated lenders generally will treat you fairly. So if you go over the term, they'll probably say, okay, well, why have you gone over the term? How long is it going to take you? And you might say, oh, I need another couple of months. Okay, we'll work with you. We'll charge you a couple of months interest. You need to pay that to us because you've used up all of the interest that you might have built into it. So you just need to service that for the next couple of months and we'll work with you. Other lenders might say, right, you've gone over term, we'll renew the facility. And they'll probably charge you a fee for that, which they're entitled to do because it's a new facility. We'll renew the facility, we'll charge you another fee. So if you want to roll it on another 12 months, you can. But what you need to watch out for in the small print, and always read the small print on what happens if you go over term. There are some lenders out there in the non-regulated territory who've got some really nasty clauses in there. I've heard of one where they say they charge the interest rate goes up as soon as you go into default. Let's say 1 day over, the interest rate goes up from 1% to 3%. Bang, straight away the repayments have trebled. Now it could be that you had retained interest in there, so you won't make any repayments. Now you contractually need to make 3 times the payments that were being rolled up within the loan for you. I've even heard of one where they charge that back to day one, right? So they say you've defaulted, you now owe us 3%, and we're going to charge you 3% on all the previous payments that you made to us instead of 1. So that's an extra 2% on all those payments. Imagine how you'd feel if you went a week overdue and you had to pay an extra 2% for 12 months on what you borrowed, plus 3% per month going forward. Get your calculator out, it's a big number. It's horrendous. So, regulated brokers, regulated lenders, steer towards those if you possibly can. Length of bridging loan, I've said regulated 12 months. Non-regulated, typically 18 months. It's a short-term product. They expect you to get things done within 18 months. But there are lenders that will go to 2 years. There are even lenders which have got, it's not really a bridge, if you like, it's almost like a short-term commercial loan or something like that. And they will go out to 36 months. But you should really be working to try and get it done within 18, unless it's regulated, in which case you must get it done within 12 months. Have I missed anything out? I don't think so. Well, I probably have. There's a lot in there. What I would say is we've got specific videos on refurbishment bridging, bridge to let, and pages as well, on development finance. So there's an awful lot of information on promisemoney.co.uk or on our YouTube Promise Money channel. There's a lot of information there, and if you're on the website now, you'll find links and buttons to get you to lots more information. Key takeaway, if I was to summarize bridging: great product. Don't be frightened by the cost. Just understand the cost, because if you're doing it for a reason, if the cost is lower than the benefit, then it's probably still worth doing. Make sure you deal with a regulated broker, because they will look at other options that might help you avoid bridging in the first place. And make sure your exit is rock solid. As soon as you've got a bridging requirement or an inquiry, the best thing to do is to just set out what you're looking to do, write it down, and then talk to an experienced bridging broker. So go to somebody who's a specialist in that, but make sure that they are a regulated firm, regulated by the FCA, to give mortgage advice, because that's going to look after your interests. That's me done. I hope that's, I dread to think how long this has been. It's quite a long one for one take. I hope that's been of interest to you, and please don't forget to like, subscribe, and generally follow Promise Money, and do get in touch if we can be of any help. Thanks a lot. Bye bye.